Let's see what's for food today. We have in the menu chicken biryani or veg biryani too. We have thali, we have sweets, gulab jamun, we have rasmalai too in the sweets, and we have some variety of snacks as well. Wow! What would you like to order? Different people have different taste for food. Some people like spicy food, some people like sweet food, some people like both. In the same way, the investing world also comes with flavors of investment strategy or investment philosophies. And these investment strategies and philosophies have been created by the greatest investors themselves, like Benjamin Graham, Thomas Rowth Price Jr., and we have John Templeton, we have Warren Buffett. All these people have given us some philosophy or some strategy of investment. So let us see what are the top 4 investment flavors. The first flavor is a value investing. So in value investing, the investor selects companies which are trading at a bumper price, at discounts. And when are these discounts available? Most of these discounts are available during depressions or during recession. So you need to hold tight with your cash. And cash is king at the time of recession and depression. When you have that cash, we have to take the strength and guts to enter into the market during that time. Value investing is about finding the intrinsic value of the company and finding what is the price traded today. If the intrinsic value is higher than the stock price, that means the stock price is trading at a 50% discount compared to the intrinsic value, then value investors jump and buy the stock. Of course, it's not necessary that 50% discount is the right price for every stock. It depends on the stock also which you're buying. And for value investors, they typically see P ratios, PB ratios, which are generally lesser compared to the historical P or PB ratios. P as in price to earnings and price to book ratios. So this is about value investing, and the main mastermind behind value investing is Benjamin Graham. So second investment flavor is growth investing. So in growth investing, that investor typically focuses on the ROE, the return on equity, or the return on capital employed, whatever capital is employed by various stakeholders of the company, how much return is finally the investor going to get as a result of all this investment. So they majorly focus on ROE and expansion of ROE over the period of time. So such companies generally come with high P or high PV, and they have a concept of the retained earnings, and these retained earnings are deployed to multiply the businesses. They buy businesses so that they can earn higher ROE year on year. They provide less dividends. So what they believe is, by retaining dividends and investing these dividends into buying assets which can earn them more over those investments, these companies earn massive wealth over a period of time. And growth investors follow the principle of ROCE. Then we have contrarian investing. In contrarian investing, the investor decides to buy a company based on the future view of its products. So there may be companies which today not many eyes are hawked upon it. The participants of the market are not hawked upon such kind of companies today because their earnings may be very little or maybe negative as well. But such companies may have a high potential of growth. They may be trading at it might appear like a high P or high PV as well, or it might even appear as a low P or low PV. But the contrarian investor finds out what is the real value of that stock at that particular point of time. And if it is undervalued, he then goes ahead and buys it based on his contrarian view. So that is about contrarian investing. And then finally we have the new flavor, which is market capitalization investing. In market capitalization, as you understand, market capitalization comes in 3 flavors. we have like large cap companies, we have mid cap companies, and then we have small cap companies. So here the investor majorly focuses on company which are small cap or medium cap. The reason is because since they're small, they have a potential of growth. They have a immense potential of growth, and because of this potential of growth, the investor majorly selects such types of company based on market capitalization. But however, please note that such companies, though might be available at low PE as well or low PE, they might be highly unstable. Their betas are usually higher than the general market. Large cap, in the contrary, they are more stable, their earnings growth is more visible, and they have a capacity to even eat the small or the medium fishes, right? They can buy out the small or the medium companies in case they have a potential, they have inspirational products which they are selling to the market. Then obviously the large cap company, because of the high reserves and surplus that they hold, they can buy out any company. So that's about the 4 investing flavors, and you can decide whichever flavor you like based on your nature. I like both value investing as well as growth investing because my mentor is Mr. Warren Buffett, and his investing strategy is also value and growth together. So we need to look into companies which pay little or less dividend and have a high ROE and ROA, and at the same time we need to buy during the bargain sale during the recession and the depression. That is when we are going to have the advantage of high returns over a long period of time. So that's it. I wanted to share about the different investing flavors, and please select your flavor as you go along. So then please subscribe to see subsequent videos. I'll be sharing a lot of videos about valuation methods, what valuation method can be followed to identify the fair price of the company and go ahead and buy at a discount from the fair price. So see you in my next video. Bye.